Good evening, everybody. I am going to restart and resolve the question. The first video had a noise problem. The audio was bad. So that's why I decided to do this second video. Please don't hesitate to point out when we have a bad audio so that I will not go back to continue doing videos. I'm already tired. So please be very much attentive to be able to come in to say if the video, if you can hear me clearly. Good evening, everyone. Hope all is well. I'm going to deactivate my picture so that we can see the full question. Okay, question 2. On 1st of January 2024, Atlas Holdings PLC acquired 75% of the ordinary shares of Better Manufacturing Limited. Let me share this one so that the first one has been removed. Is this second one that you should use now? The first one is removed. So I will share this one. I will share this. It's the one that is going on now. So share it in your class. Everyone can see the screen, right? Let me delete the first one, which is no longer visible. I have removed it from circulation, so you will not be able to see it again. This is the only one you can see now. Let me check. Okay, so this one will even be livelier than the first one. Please confirm if you can hear me. Can you hear me clearly? Confirm if you can hear me. I'll start reading. If you can't hear, I'll see, because I'm going to be on the screen for a long time listening. On 1st January 2024, Atlas Holdings PLC acquired 25% of the ordinary shares of Better Manufacturing Limited. Consideration transferred. Atlas agreed to the following. 1. Cash payment 800,000 on acquisition. 2. Share exchange. 1 Atlas share for every 3 Better shares acquired. Market value of an Atlas share at acquisition 6 naira. Contingent consideration. Atlas will pay an additional 2 million on 31st December 2025 if Better's cumulative profit for 2024 to 2025 exceeds 5 million naira. Fair value of this contingent consideration at acquisition dates 1.2 million. Fair value at December 2024 is estimated at 1.5 million. Share capital and reserves of Better Limited at acquisition. Ordinary share capital 3 million shares at 1 naira each. Retained earnings at 1st January 2024, 4.5 million. Fair value adjustment at acquisition. At acquisition date, 1. Plant carrying amount 4 million. Fair value 5,200,000. Remaining useful life 6 years. 2. Inventory. Fair value exceeds carrying amount by 600,000. Have remained unsold at 31st December 2024. 6 years. Sorry. 3. Unrecorded brand intangible. Fair value 1.8 million. Useful life 6 years. Straight line amortization. Indemnification assets. Prior to acquisition, Beta Limited had an outstanding legal claim. Fair value of contingent liability at acquisition 900,000. The former owners are indemnified at last for 80% of any settlement. The indemnification assets had fair value equal to the indemnified portion at acquisition. At 31st December 2024, the fair value of the liability is 1 million. Non-controlling interest, the fair value of non-controlling interest at acquisition was 3.1 million. Post-acquisition results of Beta Limited. Year ended 31st December 2024. Profits after tax 3.6 million. Dividend paid 900,000. Okay. Required. Okay, with this now I can bring my picture, can activate the camera. Okay. Required. Calculate the goodwill on acquisition of Beta Limited using the fair value method for NCI, clearly showing treatment of share consideration, contingent consideration, and indemnification assets contingent liability. Compute the post-acquisition movement in Beta's net assets attributable to group retained earnings, non-controlling interest. Prepare the consolidated retained earnings of Atlas Holdings PLC at 31st December 2024 extract only. Atlas Holdings PLC retained earnings 4 million. D. From an analyst's perspective, briefly discuss two implications of the presence of contingent consideration and recognition of an indemnification asset for assessing acquisition risk and future impairment or earnings volatility. So this is the requirement of the question. I'm going to put you through the solution that I have prepared beforehand. I will explain it. So the A is to calculate the goodwill. Now, the consideration transferred were in two forms, one cash, then the other one issue of shares. So the cash transferred was 8 million naira. So that is the 8 million naira you can see here. Then they issued shares to Beta, the acquiring company, Atlas, issued shares to Beta, Atlas Holding, shares exchange, one Atlas share for every 3 Beta shares acquired. So what it means is that they took the percentage holdings of the shares that Beta has. So share acquired is 75% of 3 million shares. 75% of 3 million shares will give you 2,250,000 shares. And they exchanged for every one of Atlas shares, they will take 3 of exchange for 3 of Beta shares. So the share that will be issued will be 750,000. That is 2250 divided by 3. So it will give you 750,000 shares. Then it will be valued at, look at, let's say, the market value of Atlas shares at acquisition is 6 naira. So the number of shares issued will be valued at Atlas share price. So that will be 750 times 6 naira, which will give you 4.5 million. Then you bring in the contingent consideration. The contingent consideration is 2 million at the end of 2025. But however, as at the date of acquisition, the fair value of contingent consideration was 1.2. So it is that 1.2 that you are going to use. It is that 1.2 that you use. So we have 1.2 there. So when you add the cash transferred, the share issued, and the contingent consideration, all in fair value, if you add them together, you have a total consideration of 13,700,000. Then you add the fair value of NCI, 3.1 million, to get consideration plus fair value of NCI, 16,800,000. Remember the calculation of goodwill, the A minus P, A equal to consideration transferred plus non-controlling interest plus if there is any previous consideration that was made for companies acquired in stages minus the identifiable net asset, which is B. So that is what how we calculate goodwill. Now we have gotten the value of A1, 2, and 3, I, and III, though there is no III in this one. So the total value is 16.8 million. Then we look at the fair value of identifiable net assets. So the book value of net asset, we'll take it from the share side, the share capital side. We already know that net asset is equal to equity. So here we have share capital of 3 million and retained earnings of 4.5 million. Then total will give you 7.5 million. So we need to also consider all the movements of the assets so that we will consider them at their fair value. So these are fair value adjustments that we are going to make. The first set of it here, this 7.5 million is the book value. So we want to adjust for the fair value. Sorry, let me remove the camera so that the goodwill will be seen. After that, I will come back to reactivate the camera. So we have fair value adjustment. The plant was uplifted or increased by 1.2 million. Inventory also by 600,000, and brand intangible 1.8 million. Then we have the contingent liability, which we are going to deduct from all these fair value adjustments. So the total will give you, hello, read this. Yeah, please, I'm in online class. Okay, the net fair value adjustment will be 2.7 million. So after the net, the fair value adjustment, you now have net fair value of net asset to be 10.2 million. So when you remove 10.2 million from the consideration, you have 6.6 million. That is the goodwill. So goodwill calculated. Question A answered. I hope you understood it very well. If there is any question, let me know so far. Is there any question? Okay, I believe that you should have digested it. So we'll go on. Then question B is saying compute the post-acquisition movement in Beta's net assets attributable to goodwill to group retained earnings, non-controlling interest. So let's go and do that. So we have the post-acquisition movement. The first one we look at is plant depreciation, 1.2 million. At acquisition, plant was 4 million and revalued at 5.2 million. We must charge depreciation on the increase. So depreciation on the increase, and they said the useful life of the plant is 6 years remaining. So on straight line method or basis, we are going to divide that increase by 6 to have 200,000. So that's what we're going to charge as depreciation for that year. Then brand amortization, we have 1.8 million, also to last for 6 years. We're going to take the whole brand amortization because of what they said. They said unrecognized brand amortization, which means it is not in the book. So it's not a matter of increase, it's a matter of unrecognized. So we're going to take 100% of that brand. And then it says it's going to have, it has 6 years life, useful life. So we divide it using straight line method too. We have 300,000 naira as amortized value for the year. Inventory unrealized profits of that inventory, say 600,000, and for half of the inventory is outstanding. So it's the half that we'll take, which is 300,000. Then we also have the contingent consideration remeasurement. Increase to 1.5 million. Then the acquisition value was 1.2 million. So when you remove 1.2 million from 1.5 million, you have 300,000 naira. That is a loss that will be charged to profit or loss. Then the contingent liability increased from 900,000 to 1 million, having a difference of 100,000. That 100,000 is loss because the liability has increased from 900 to 100,000. So there is a difference of 100,000, which is going to impact the profits. Okay. Then we have indemnification assets of 80%. So let's look at what the indemnification asset stated. Prior to acquisition, Beta Limited had an outstanding legal claim, fair value of contingent liability at acquisition, 900,000. The former owners indemnified Atlas for 80% of any settlement. The indemnification asset had fair value equal to indemnified portion at acquisition. At 31st December --, that is the 80% we are considering here. So the net impact will be 20% loss. That's 100% minus 80%. They're going to indemnify them 80% of the loss that they are going to make. So here we come to compute the profits of Beta that will be attributable to the group and the NCI. So we have the profit of Beta is 3.6 million. You divide it into 75% and 25%. So for the group, we have 2.7. For NCI, we have 2.5. Then the planned depreciation, 200,000. We divide it 75% and 25%. Then inventory, unrealized profits from inventory, we have the 300,000 divided into 75% and 25%. Brand amortization of 1.8, we have 300,000 amortization to be divided into 75% and 25%. So we have 2.1 million for group and 1.700,000 for NCI. Then we look at the contingent liability consideration, which is purely the parents' own. They are the one that will make the contingent consideration. So it does not affect NCI. Then the contingent liability also does not affect the NCI, neither does indemnification asset affect the NCI. So in that case, we have 1.780. This is what it is. Then we remember that dividend was paid of 900,000. Out of that dividend that was paid, 75% of it belongs to the parent. So that is this 675, while the rest belongs to NCI. Sorry, I didn't include that of NCI. So the total amount of the group, of the profit or better that will be transferred to the group is 1105. So question B has been answered. We will go to question C. Let me go back and see if there is any question. There is no, is the goodwill, is there loss in the goodwill? Why is what loss? Where is the loss coming from? There is goodwill now, 16.8 minus 10, that is goodwill. So where is the loss coming from? What it means is that the consideration is higher than the net asset. So we have a goodwill of 6.6 million. So I don't know where the loss you're talking about is coming from, except you clear me further. Okay, contingent liability. Okay, let me explain it again so that you understand what I mean. Now, what we're saying is that the value of the contingent liability was 900,000. That's what the liability is. Then in acquisition in the year, the contingent liability increased from 900 to 100 to 1 million, which means this is what the company is liable to pay. Instead of paying 900, they will now pay 1 million. So what it means is that there is a loss. There is a loss of 100,000 because they are going to pay additional 100,000. They were to pay 900,000, but now they are going to pay additional. They are going to pay 1 million, which means that additional 100,000. So that additional 100,000 is a loss that they are going to make up for. That's why it's a loss. But the better company has agreed to indemnify them 80% if there is such thing. So they are going to, that 80% becomes an indemnification asset to the company. So what it means is that while the company is going to pay 100,000, they're going to get 80,000 from the company they bought, and then there will be a difference of 20,000. So what they're going to pay effectively is 20,000, because after paying 100,000, they refunded 80,000 to them. They will have, they will still have paid 20,000. 100 minus 80, that is why it's a loss. I don't know whether that is able to answer your question. So that's what I'm saying. Or are you talking about the contingent consideration remeasurement? Increase of 1.5 million minus 1.2 million. That's 300,000. This is going to be charged to the profit or loss. And it's going to be a charge. When it's a charge, it has reduced the profit, so it's a loss. If you had a profit of 500,000 and you charge 300,000 to that profit, have you not reduced the profits by that 300,000? So that is why we call it a loss. If the contingent, if it has, the remeasurement brought it down, they will have a gain. As we remeasured it, and it's instead of 1.5, we now have 1 million. Would have made a gain of 200,000. But now we remeasured it and we have 1.5, which is higher. Okay, so okay, now I'm trying to explain the contingent consideration remeasurement. I'm saying that since the thing increased from 1.2 to 1.5, what it means is that there is a liability that has been created of 300,000. 300,000 naira is a loss because it's a liability. We are going to pay it. Assuming the measurement was downward, instead of 1.5, it's now 1 million. Would have made a gain of 200,000. So that is where the loss is coming from. Okay, so the answer to C is consolidated retained earnings. Owners or parents from the question is 400 million. That is their retained earnings. Then from beta, 1.105, which we calculated. So total, 5.105. Any further question? Do you understand now? Brakemi, do you understand why it is a loss? Have I been able to explain it? It was 1.2 and increased to 1.5. So the liability has increased. Okay, so we have answered question C. We are going to look at the last question, the answer to the last question, question B. Analysis interpretation, contingent consideration. This creates earnings volatility through remeasurement, like you have seen, from 1.2 to 1.5. And there is a loss of 300,000, which is going to reduce the earnings for that period. Indicates uncertain acquisition valuation. So what it means is that the valuation that was given was not actually correct. That's why they are asking for more consideration, even though that consideration is hinged on something. But ordinarily, if they had given a certain valuation at acquisition, there wouldn't have been any need for contingent consideration. Then the implication of indemnification asset. This reduces downside legal exposure. Look at in the indemnification asset, in the contingent liability that was there was 900,000, increased to 1 million, exposed the company to additional 100,000. But however, there was an indemnification asset of 80%. So this reduced the exposure of 100,000 to 20,000. You see, if they had also agreed to indemnify 100%, that means there wouldn't have been any exposure. So indemnification asset reduces or removes legal exposure. Now, what does it indicate? It shows pre-existing risk in acquisition. It means that there is a risk in what the company you are acquiring. Because if there is indemnification asset, that means there is a contingent liability. Indemnification asset is derived from contingent liability. Without contingent liability, there will not be indemnification asset. So, which will lead to possible goodwill impairment. So that is the implication of indemnification asset. So this is the solution to the question. I don't know if you have more questions to ask. Jimbo, you're saying you understood by the grace of God. Grace of God works in everything now. So thank God, grace of God worked here. So this is the solution to the question. I am sure when we go back and solve it once again, we'll understand it more. It wasn't expected that I was going to redo the video. But however, I have redone it and I hope it helps. I want to thank every one of you, and I will say the next video will be on group account. That will be on Saturday evening because I'm not going to do any video tomorrow. So you can prepare yourself on Saturday evening for the group account. Meanwhile, go and solve it to see whether you can solve, whether your solution and my solution will agree. Thank you very much. There wouldn't have been any exposure if it was 100% indemnified. So it would have been zero. That's why you see I deducted 100% and added 80%. So the net is 20. Guys, let me show you again. So you see there is 100 here, there is 80 here. So that's why the loss is reduced to 20,000. If it is 100, it would have been zero. There wouldn't have been any loss. Okay? So that's the correct answer to your question. Thank you very much. Thank you all. Thank you all and good night. Okay.